Welcome to The Deep Dive, the show that extracts the essential knowledge from the most important reports and earnings calls, giving you that critical shortcut to being well-informed.
And today, we are really digging into something complex.
We are. We're looking at the Q3 2025 earnings call for Venture Global Inc., or VG. This one dropped pre-market back on November 10th.
You know, this call was less of a simple earnings report and more of a study in corporate conflict.
A study in contrasts, for sure.
Yeah. I mean, on one hand, VG delivered an impressive, you could even say historic operational quarter.
Record LNG volumes, a massive revenue beat.
Exactly. But all that good news was packaged right alongside a simultaneous guidance cut and, the continued specter of these legal battles.
It's the definition of a mixed bag. And for anyone trying to analyze the future of this company, you have to reconcile these two competing realities.
Right.
How did a massive top-line revenue beat and, frankly, the fastest cargo ramp-up in the industry lead directly to an EPS miss and lowered full-year guidance?
And that conflict is precisely why the market reacted with such extreme volatility.
So we're going to unpack every layer of that story for you.
I think to set the stage, we should just start with the hard numbers for Q3, because the growth it's staggering, and it's critical context for everything that follows.
He'll walk us through them.
All right, so revenue came in at $3.33 billion.
Which beat expectations.
Comfortably. Beat the consensus of $3.23 billion, and here's the kicker. That represents a massive 260% growth compared to the same quarter last year.
Wow.
So that operational success, you can see it clearly translating to the top line.
And what did that kind of performance do for the bottom line?
It fueled a really powerful swing to GAAP profitability. GAAP EPS was 18 cents.
Which is a huge turnaround from, what was it, a loss last year?
A net loss of 15 cents a year ago, yeah. So net income hit $429 million. That's a nearly $0.8 billion improvement year over year.
You just don't get swings like that without some massive operational firepower.
Absolutely not. And the metric that truly defines this quarter is the adjusted EBITDA. It hit $1.53 billion.
It's up how much?
Up 439% year over year.
Just incredible numbers.
The driver was pure volume, primarily from the Plaquemines facility ramping up. I mean, VG exported a staggering 100 cargoes this quarter.
100. Compared to what?
Compared to just 31 cargoes in Q3 of 2024. That is the definition of scaling an infrastructure asset.
But with this story, despite all that record execution, the market didn't give them a complete pass. We mentioned the miss.
Yes. The market, especially the sell-side analysts, they really focus on that adjusted earnings figure.
Right.
The non-GAAP, or adjusted EPS, was 16 cents. And while that's still profitable, it missed the consensus estimate of 22 cents.
So mastery of operations, huge revenue, but they stumbled on that final adjusted profitability metric.
They did, and it's primarily due to the higher operational costs that came with the very speed we're talking about.
Okay, let's unpack that operational ramp, because the speed of construction and commissioning is the entire central thesis for the long-term VG investment case.
It is. The results were driven by that ramp up at Plaquemines LNG, and also the stabilized output from Calcasieu Pass, which we'll just call CP1.
And Plaquemines is the real story right now.
Plaquemines is the engine. It exported 64 commissioning cargoes in Q3 alone.
Just in one quarter.
Yeah. To give you some perspective, that's a 25% sequential increase, quarter over quarter. And management was extremely firm in affirming that Q4 2026 commercial operation date, the COD schedule for Phase 1.
They keep talking about this aggressive 54-month construction timeline. For people listening who might not be LNG experts, why is that number so important?
Because it is fundamentally disruptive to the entire sector.
How so?
The typical industry timeline for a project of that scale, from groundbreaking to COD, is usually 6 to 7 years, maybe even longer.
No.
VG is targeting 54 months. 4.5 years. If they hit that Q4 2026 date, it basically validates their whole modular fast-track approach and establishes them as the low-cost, high-speed provider globally.
That's the secret sauce investors are buying into.
It is. But that blistering speed, it clearly comes at a significant financial cost.
Right. Management was pretty candid about using temporary power solutions, and crucially, they acknowledged injecting about $3.3 billion of additional equity capital.
And that is the cost of prioritizing schedule over short-term budget discipline. $3.3 billion is a massive commitment of self-funding.
They're essentially paying a premium.
A premium to manage construction and EPC delays, that's engineering, procurement, and construction delays, just to hold that 54-month timeline. They are telegraphing very clearly that speed is priority number one.
Even if it hits near-term cash flow.
Even then.
And that brings us directly to the guidance cut, which was the key friction point in the entire call. Despite the revenue beat, they lowered and narrowed the 2025 adjusted EBITDA range
to 6.35 to 6.5 billion. Down from the previous range, which was 6.4 to 6.8 billion.
So if volumes are up and revenue is beating, how do you explain cutting future profit guidance?
It came down to two key factors, and both are related to risk.
Okay.
First, they're seeing lower fixed liquefaction fees being contracted for the unsold cargoes left in Q4. This just reflects slightly tighter winter spreads than they had modeled.
So conservative pricing on the last few bits. That makes sense.
And the second reason, and this is maybe more important, is the financial impact of the legal issues. They are now incorporating accounting reserves that are tied directly to those ongoing arbitration processes. It's a forward-looking recognition of a potential liability.
What's truly fascinating here, though, is how the company has strategically de-risked itself from broad commodity swings.
That's a huge point.
A year ago, their business was highly sensitive. We used to talk about how just a $1 per MMB2 change in the fee would impact their EBITDA by a gigantic $230 to $240 million.
And that metric right there is the proof of concept for their pivot to long-term contracts.
How so?
They've successfully signed enough long-term sales and purchase agreements, SPAs, that the same $1 swing now only impacts their EBITDA by about 50 to 60 million.
That is a monumental strategic shift.
It absolutely is. It means the company is successfully transitioning from being seen as this high-risk commodity beta stock where you live and die by short-term gas prices to a real infrastructure company with stabilized, contracted cash flows.
That shift is probably the most bullish takeaway here, maybe even more than the revenue beat.
I would agree.
So if they're working hard to lock down cash flows in the near term, that makes the long-term commercial pipeline even more critical. Let's shift our focus to strategic growth. What does that pipeline look like beyond Plaquemines?
It looks very strong. In the second half of 2025 alone, they signed over 5 MTPA. That's million tons per annum of new 20-year SPAs.
So new long-term deals.
Yeah, this anchored over 5.25 MTPA of incremental sales, including major new deals with Navy of Spain and a minimum half MTPA contract with Atlantic CLG.
And that's that Greek joint venture.
Right, which is highly significant for energy security in the Eastern Mediterranean.
So the demand picture for their future capacity is definitely there. What about their next major project, Calcasieu Pass Phase 2 or CP2?
CP2 is still moving forward aggressively. They noted over 3,500 workers are already on site.
Wow.
And construction progress includes installing over 10,000 of the required piles. That's about a third of the total 32,000 they need for the foundation.
So they're executing on the next wave of value creation while still finishing the last one.
That's their model. And they're building a very aggressive financial model around CP2, too.
How so?
Management projected that the project's net cost will actually be reduced to about $21 billion.
Reduced how?
By accounting for an estimated $8 billion in cash flow that's generated specifically from pre-cargo sales.
So the sales they make before the plant is officially open for business are paying for the construction.
Exactly. Those cargoes aren't just filler. They are a critical financial component of the entire project model. It lets them fund a huge chunk of the development themselves.
And here's where that high-stakes risk comes right back into play. The litigation overhang.
The elephant in the room.
You cannot discuss this company without addressing the legal disputes, particularly around CP1. It seems that aggressive schedule may have come at the cost of some strained customer relations.
That connection is hard to deny. The disputes largely stem from the companies selling those commissioning cargoes pre-CD instead of fulfilling contract obligations for their long-term buyers.
And what's the latest status?
We've got some clarity. The Shell arbitration was decided in VG's favor, which was positive news. However, they did acknowledge a partial decision went against CP1 in the BP arbitration.
So a mixed result there. What's the net effect of all these legal proceedings they're facing?
Well, the good news, if you can call it that, is the total remedies being sought by customers were materially reduced.
Okay.
Previously, the range customers were seeking was between $6.7 and $7.4 billion.
Yeah.
That range is now down significantly narrowed to $4.8 to $5.5 billion.
Still a huge number, but a material reduction is a relief.
It is.
So how are they dealing with that remaining liability on their books?
They address this by detailing a new accounting measure. VG is now booking a non-cash accounting reserve of $14 to $15 million per quarter.
Every quarter.
Every quarter. And this will run through the entire 20-year duration of the contracts. This reserve is basically management's best estimate of what the ultimate arbitration awards will be.
It's a way of recognizing the potential liability without drawing down immediate cash.
Precisely.
But in a worst-case scenario, can they actually afford a large settlement? What's their liquidity position look like?
Management was keen to emphasize their confidence there. They highlighted that the aggregate liability cap for the 4 remaining arbitrations, excluding the BP case, is $765 million.
And their cash on hand.
When you look at their war chest, over $3.5 billion in cash, plus a new $2 billion corporate revolver, they believe they have substantial financial firepower, north of $5.5 billion.
So enough to manage potential exposures over the coming years without jeopardizing growth.
That's the argument they're making.
This all ties back to the investor context. VG is positioning itself as the ultra-low-cost producer, aiming for all-in costs just above $1,000 per ton for CP2.
Right.
The operational execution is there, the pipeline is growing, but the legal uncertainty and that guidance cut made for a really confusing day on the stock market.
It was a fascinating case study in conflicting news cycles. The shares initially popped, and popped strongly, up nearly 11% pre-market.
Because the momentum traders just saw the headline.
Exactly. They focused purely on the massive revenue beat and the cargo ramp. That's the short-term sugar rush.
But then the sophisticated investors started digesting the details.
Exactly. Once people processed the guidance cut, the acknowledgement of the BP arbitration loss, and the need to actually book an ongoing reserve, well, the enthusiasm faded.
And the stock ended where?
It still closed up 6.3% on the day, but with trading volume 2 to 3 times normal turnover, it just shows a major battle between those buying the long-term high-growth infrastructure thesis.
And those betting on short-term news flow and legal risk.
That's the whole story.
Let's talk about the aha moment management tried to pivot toward technology.
Yes, this was interesting. They view their facilities not as standard industrial factories, but as complex data-driven machines.
They mentioned streaming data points.
Yeah, they revealed they're currently streaming around 22,000 data points every 10 seconds from Calcasieu Pass alone.
That level of telemetry is highly unusual in this sector.
It is, and it helps explain how they maintain their speed advantage. That real-time data analysis lets them achieve higher throughput and operational optimization.
So it's why they're talking about expanding CP2.
It's why they are planning expansions that could push CP2's potential capacity up to a staggering 30 MTPA. They're using data to squeeze more production out of fewer trains.
And tying this back to the broader sector outlook, the macro environment is incredibly supportive of this aggressive expansion.
It really is. Global LNG demand remains robust, driven not just by geopolitics, but by emerging factors like the immense power consumption required by AI and massive data centers.
A new source of demand.
A huge new source. And that macro backdrop reinforces the expectation that spreads above Henry Hub will remain substantial through at least 2028.
So the company is executing its pivot from a speculative story stock to a massive scaled LNG cash generator.
But as we've seen, the equity remains volatile. It's carrying that litigation discount and the overhang of the capex creep needed to maintain that blistering pace.
Okay, now for the segment where we explore potential investment theses based on the reported data. And as always, a critical disclaimer.
This is absolutely not financial advice. We are simply analyzing potential scenarios.
We encourage you to do your own diligence before making any investment decisions. This is purely a thought experiment based on the operational and legal conflict we've just outlined.
Purely a thought experiment.
So, given this tension between massive execution and this persistent legal risk, what trade idea emerges from this volatile picture?
I think we are playing the long-term litigation discount versus the proven execution upside.
With a structured trade.
Yeah, a structured trade looking out several years. The core thesis is that VG is delivering unprecedented scale. I mean, remember that 439% EBITDA growth. But the stock is being held hostage by these high-profile legal issues and negative news cycles.
And that volatility is masking the long-term value.
It's masking the high-return infrastructure being built, particularly CP2,
Right.
where the project return on equity is projected to exceed 30%.
So how do you capture that long-term infrastructure value while trying to mitigate the short-term legal drama?
The recommendation here would be something like a long-dated, deep-in-the-money call option, looking 2 to 3 years out, or maybe utilizing a call spread.
And you're targeting what?
You're targeting a price re-rating that moves the stock from its current sort of growth valuation toward a stable, infrastructure-like valuation.
But you have to hedge the short-term noise.
You do. This position needs to be paired with a short position on near-term volatility products or even short-dated put options to capitalize on the continued legal uncertainty and news cycling that will fog up the long-term story.
And the whole trade really hinges on what?
It hinges entirely on VG hitting that Plaquemines saccade in Q4 2026 and demonstrating they can successfully contain further arbitration costs to that estimated $14 to $15 million quarterly reserve.
So that's a bet that infrastructure delivery ultimately trumps legal friction in the long run.
Precisely. You're betting on management's ability to build faster than their lawyers can lose.
So the core takeaway from the Venture Global Q3 call is defined by this conflict. They posted massive operational results, record revenue, record cargoes. But the narrative was ultimately defined by the strategic decision to prioritize schedule and growth,
Which meant injecting billions in additional equity capital.
while at the same time aggressively attempting to contain the legal landscape by establishing those arbitration reserves.
They're executing at a pace that is just unprecedented for the LNG industry, but that pace seems inextricably linked to these strained customer relationships, which is forcing them to spend billions to manage the resulting risk.
Which leaves us with this final provocative thought for you to chew on. Given VG's proven ability to achieve industry-leading construction timelines, that 54-month schedule for Plaquemines, but their ongoing challenges in managing customer relations and arbitration awards, which factor will ultimately matter most for the stock over the next 4 quarters? Speed or trust?
That is an existential question for a company that's transitioning into a major global energy player.
We'll see you next time on The Deep Dive.